We have just left a spectacular year in 2018 where we came into the year on a roaring euphoria before the big volatility shock in February. We came all the way back to new highs, and then in the Q4 and specifically December, we had a massive rout in global equities. US equities were down 9.2% and even more at the low point just around Christmas. And you don't get these monthly declines for nothing. If you go back in history, this was the second largest decline in a December since 1927. And if you go back history and you look what happens after these massive monthly declines, the evidence points toward actually quite positive returns in the following 3 months, but it comes with a massive amount of volatility. We have a few periods in the 1930s where a very big decline in a monthly return, or even in December, was followed up subsequently by sharp declines, specifically in 1931, where we had a further decline of 45%. I'm not going into this Q1 with a lot of confidence on this actual direction. I think the main theme here is that there will be a lot of volatility. I see very high probability for either the equities going up 20% or down 20%. We have one call if you want to have a relative play here, and that's actually looking at Japanese equities. We see very low valuations. We see sort of strong relative performance in Japanese equities. So despite of the big decline in Q4. So if China and the US strikes a temporary trade deal, we think Japanese equities could be an interesting play here in Q1. However, more long term, we are still defensive on equities. We think we're in the final act. 2019 is going to be a very troublesome year. We don't want investors to have more than 25 to 30% of their asset allocation portfolio in equities, and the equity exposure should be mostly defensive. So minimum volatility equities, mostly consumer staples, healthcare, telecommunication and utilities. Then also in Q4 of 2018, we were bullish on value stocks. That was a very good play. We're not that bullish any longer on value stocks, and that's because the Fed have now changed the tone from maybe what was a policy mistake when they did a relatively hawkish hike in December, and now thinking maybe easing monetary policies in 2019, or at least if the market or the economy demands so. Emerging markets, we're bullish on emerging markets. Emerging markets really outperformed in Q4, but we don't really like emerging markets going into Q1 here, so maybe a little more hesitant. So as you can see, we're not very confident. We do expect volatility to remain high, and look for Japanese equities, potentially also Hong Kong equities, if we get that trade deal between the US and China, which is crucial for market sentiment here.